Hello, everyone. Welcome to this webinar organized for you by the Amsterdam Institute of Finance. My name is Paula Jääskeläinen and I am Business Development Manager at AIF. As we are currently not able to organize our face-to-face courses, we want to enhance knowledge sharing online, and therefore we continue with our series of webinars. Today, we are very happy to welcome as our guest speaker, economist Peter De Keyzer. Peter is managing partner of the Belgium-based advisory firm Growth Inc., and he has extensive experience as economist and chief economist at, for example, ABN AMRO Bank, KBC Asset Management. He's a regular contributor to international and Belgian press on economic growth, financial markets, the Eurozone. And Peter is also a guest lecturer at the University of Antwerp. At AIF, Peter De Keyzer teaches a very successful, highly rated two-day course called Understanding Global Macroeconomics. This course is, I suppose, always relevant, but in these current times, it's more relevant than ever. We will be holding it again in Amsterdam on the 5th and 6th of October, of course, assuming that the global situation has stabilized by then. And just to assure you, any and all of our face-to-face courses will be compliant with the Dutch government's safety and healthy measures. Today, we will hear Peter De Keyzer's views on the impact of the corona crisis on the financial markets. We have about 60 minutes for this webinar. You can type in your questions for Peter in the Q&A section on your screen. And he will take some time at the end of the webinar to answer them. We have a big crowd present here today, so he will do his best to address as many questions as possible. Also, he will probably be asking you some questions as well. You can find them under the polling section. He'll make them available when it's time to give your opinion. Towards the end of the webinar, we will be sharing the presentation that Peter De Keyzer is using today, and that you will find under the handouts section on your screen. And also, no worries if you have to miss a bit of the webinar today. Everybody will receive a link that you can use to watch the recording back afterwards at your own time. And now we're ready. We will switch over to Peter De Keyzer.
Okay, thank you very much. So I think the floor has been handed to me. Thank you very much for the introduction. So as said, I will take about 60 minutes, of which about half the presentation, and I'm hoping that about half to a third, I'm hoping to answer your questions, which you're more than welcome to give to me. I'll run you through the main consequences of the Great Lockdown and the impact of the Great Lockdown and what exactly is happening. And let's switch to the slides. That'll make it easier for me to tell the story. Now, you can see the front page, the first page of the presentation isn't really that uplifting. You see an economic, not an economic explosion, but you see a nuclear explosion. And I tend to compare this crisis or this Great Lockdown to a nuclear explosion, because there's three phases. First of all, we've seen the lockdown itself, so the pandemic which struck, the lockdown which ensued, and of course a number of companies which didn't survive the lockdown itself, and which went bankrupt, which I would compare in the nuclear explosion terms to the flash of the nuclear explosion. And a nuclear explosion is three phases. There's a flash, there's the shock wave, or the destructive wave of the aftermath of the explosion, and then there's years and years of radiation of after effects of the nuclear explosion. And I would basically divide this crisis, or this economic crisis, the lockdown, in three phases as well. First, there's the flash that we have seen. It's the pandemic, it's the lockdown itself, it's the temporary unemployment, it's the closures of companies. Then there's the aftershock, and that is what we will be witnessing in the next couple of months. A number of companies which won't be able to survive in a 1.5 meter economy, and that is something we have to take into account. And then finally, the radiation. This is basically the fact that for multiple years, what is happening right now will have an effect on the way we conduct business, on the way financial markets look at risk, on the way countries are interacting with each other. This is a very, very important one. Now, we've seen that the fall, the collapse in activity was extremely brutal over the past couple of months. And since the first quarter, we've seen sharp contractions in economic activity. And the United States expects even a contraction of economic activity by 30%. So that's 30% in the second quarter. And that's why I would like to ask you the first question. So before I'll deal with that in more detail, the first poll is, which kind of recovery do you expect? So I've opened up the poll so the question is, the economy is gone off the cliff. Do you expect the economy to recover in a V-shaped style? Do you think it will be a U-shaped recovery? So that is a relatively gentle recovery, not really a fast recovery, or an L-shaped recovery? Well, L-shaped is not really a recovery. It is falling off the cliff and then flatlining for an extended period of time. And I see that the different answers are actually coming in. They're stabilizing right now. I would say approximately 10% thinks we're going to go for a V-shaped recovery. There's about 60% that says U-shaped recovery, and then there's 30% which says L-shaped recovery. And this is very interesting to see, because when the crisis actually struck in the beginning of the crisis, what you saw is that institutions like, for example, the International Monetary Fund or the OECD, they actually worked on the assumption that we would have a V-shaped recovery. So the idea was a sharp fall in activity right now, but an extremely fast bounce back next year. Now, given your answers, I mean, the fact that you actually see and feel the economy, see what's happening, you tend much more towards a U or even an L-shaped recovery. And this is in line with what I'm thinking as well, what I think is going to happen. Now, to give you an impression of how big the fall in activity has been, this was the front page of the New York Times 2 weeks ago, May 9th on Saturday. It says U.S. unemployment is worst since Depression. And you see actually here since the 1940s, and it went even before that, you saw that the fall in the number of unemployed people actually being added. So every positive bar here is employment being added, and every red line here is employment being cut, so jobs getting lost. So from this illustration, you already see that it's quite a sharp fall in economic activity. But to see that this is, for example, the dot-com crisis. This is the financial crisis, 2007, 2009, which was quite sharp as far as job losses were concerned. But judging by this bar, it's brutal already. But if you look at the true picture, you need to turn the front page of the New York Times on its side, and this is actually the true fall of activity. Yeah? You see the bar on top there. It's actually massive. If you compare it to what we've seen in the past, about 22 million people have lost their jobs in the first 2 months, and that is, of course, something that will determine also the impact, the return to normalcy. An economy that falls off a cliff very, very fast is an economy that is not really one that is going to bounce back very soon. There's too many people unemployed. There's too many firms going bankrupt. So this hinders the recovery. So again, this pleads, as far as I'm concerned, the fact that it's so deep pleads against a V-shaped recovery. Now, what about the bigger picture? If you look at the bigger picture, what kind of shock have we actually seen? So if you look at macroeconomics, there's a number of shocks that you can see. We've basically seen a lot of them at the same point in time. There's a demand shock. There's temporary unemployment, which leads to income loss and less consumption. There's company closure, so they consume less as well. If your restaurant is closed, you're not going to order any vegetables. You're not going to order new tableware or cutlery or whatever. So you consume less as well. And there's uncertainty, so you don't invest. You don't start expanding your business. You don't start adding production lines. So it's a demand shock. There's less demand. It's also a supply shock. The companies are closing, supply chains are being disrupted. So you see a number of bankruptcies. So look at the airline industry, you're seeing bankruptcies there. You see credit losses at banks. So banks are actually seeing credits which are not repaid because companies are going bankrupt. And so they might react to that by imposing tighter credit standards. They want to become as safe as possible and extend less credit in an economy that is doing very, very badly. And so there's going to be excess capacity. We have a number of factories which will run at half capacity, 60% capacity for some time to come. So it'll take some time before you start investing again. And then there's a trade shock. Global supply chains are disrupted. If you're an international company that produces parts in China, in Bangladesh, in India, in Australia, and then ship them someplace else, all the supply chain will be disrupted, and this will weigh on activity. And of course, this weighs on exporters' income as well as on their confidence. Now, to give you an idea of how big the scale of the crisis was, this is something that Martin Wolf wrote in the Financial Times a couple of weeks ago. He says, whatever we call it, this is clear. It's the biggest crisis the world has confronted since the Second World War and the biggest economic disaster since the Depression of the 1930s. The world has come into this moment with divisions among its great powers and incompetence at the highest level of government of terrifying proportions. We will pass through it, but into what? And so there's a number of interesting things here. First of all, the biggest economic disaster since the Depression. We always thought that these huge economic shocks came from a financial market crisis or from speculation or something else. Right now, it's a disease, and people get locked in their house, and we're facing the biggest economic disaster in a century. To give you an idea, this is what the world economy did during the financial crisis, the global financial crisis of 2009. The world economy contracted by 0.1%. Based on the International Monetary Fund's forecasts right now, we should be facing a contraction of about 3%. And I mean, this goes back a couple of weeks already. And in the meantime, the IMF has had to admit that they've been wildly optimistic in their initial forecast. So it's going to be bad. It's going to affect a number of parts of the economy. Now, a final one to give you an idea of the bigger picture. This is a study that was done by some Belgian economists, or some data that was gathered by some Belgian economists last week of the University of Louvain. And so this shows for Belgium, but this also applies to a number of other countries. And let's say the shock that affects European countries is similar. So the bigger picture should be similar. Again, the annual growth of your GDP per capita between 1847 and 2021. So you see the First World War, that's a very, very big hit to your prosperity. And it's a war, of course. And after the First World War, you see a recovery, your prosperity. The 1930s, that's the Great Depression in Europe, minus 5.2% of a shock to your income. The Second World War, and then we've had periods in which we lost income per head of capita, but those were very rare. It's 1975, it's 1993, it's the financial crisis, but this is going to be a big one as well, which is on par with what we had in the Great Depression. And again, as said, and as your answers illustrate as well, I don't think the 6.2% increase is realistic, and for a number of reasons, which we will deal with in a short while. Now, let's talk about the recovery. What will the recovery be what will it be like in the next couple of months, quarters, or years? I often compare it to a car crash. If I tell you that there's a car which went from 100 kilometers per hour to 0 kilometers an hour, and ask you what will be the acceleration of the car after it came to a standstill, then I would expect you to ask me the question, did the car come to a standstill because it braked or because it crashed into a wall? And that determines your acceleration pace after the crisis or after the crash, and this is exactly the same. And so you're seeing that the economy is hurt, the supply side is hurt. There's a number of companies going bankrupt, and they will not be able to contribute to the recovery. And coming to your initial answer to the poll question as to whether we would have a V, a U, or an L-shaped recovery, I guess your hunch is in line with what I'm thinking. It's going to be more of a U or an L rather than a V. But if we go into more detail, a V-shaped recovery would mean that there's no damage to the supply side. You switch the economy off, and 8 weeks later, you switch it back on. Everything works perfectly again. It's like a car which has been outside for 2 days. You switch it on again, and it runs again. And no second round crises. A U-shaped recovery means that the supply side is damaged. There will be some bankruptcies, there will be higher unemployment, there will be broken business models. These are, for example, airlines, which will not be profitable if they can only carry 50 people in an airplane. These will be certain restaurants, which, if they have to respect the new rules, will not be profitable if they can only see 90% or 80% or 60% of what they had in clients before the crisis. But yet still we assume no second round crises. L-shaped recovery would be the worst of all worlds. It would be supply side is damaged, and there would be second round crises, a banking crisis, a Eurozone crisis, protectionism, a political crisis, etc. And so let's maybe go to the next poll then, which is, what will be the next crisis? Coming from this one, will it be a banking crisis? Do you expect the Eurozone crisis? Populism or extremism, which rises? Think of what you're seeing in the US right now, the anti-lockdown movements. Or do you say, let's say in the next year and a half, I don't really expect subsequent crises? Let's see what you think of that. Okay. I think the ideas are forming already. There's a tendency there. Let's say the optimists are in the minority, so there are some people that don't expect a subsequent crisis, think that this one is bad enough as it is. But if we look at the answers in total, if we look at it, let's say about the same amount of people think a banking crisis 16%, or no extra crisis about 11%. Maybe the no subsequent crisis people are the same ones that foresaw a V-shaped recovery, because if there's a V-shaped recovery, we can emerge pretty quickly out of this. 38% says a Eurozone crisis, and 35% says a populism or extremism crisis. I think this is very interesting to see, and it'll lead me to a number of insights for what follows in the presentation. So let's look at the economic consequences. And of course, there's economic consequences, but there's also, and that is what I asked you in the poll, there is also strategic consequences, geostrategic consequences. So policymakers will be front and center for a long time. The people you see on the news, in the newspapers, on television, they're the central bankers. It is the presidents, it's the prime ministers, it's the ministers of finance. They're the ones doing the heavy lifting, especially central banks. They're pumping billions and billions and trillions into the system to keep it from collapsing. And this is a good thing. They should do this. The last thing you want to have is a liquidity crisis. So there's enough liquidity in the system. Banks can actually borrow at negative rates. This is a good thing. Fiscal policy will come to the rescue. There was a 500 billion euro plan that Angela Merkel and Emmanuel Macron announced yesterday to actually save the Eurozone. So there's a lot of debt being made to actually get growth going again. But this will lead to a gigantic peacetime increase in debt. To give you an idea, by all calculations, it's reasonable to assume that Italy will see its public debt to GDP ratio increase from 130% of GDP right now to about 180% of GDP by the end of this year. Now, the European Commission doesn't publish figures like that. They see a much, much more rosy picture, because if they would have to say that Italy goes to 180% debt to GDP, you would have to admit that you have a new Greek problem on your hands. all of a sudden, Italy would become a kind of Greece, but on an Italian scale. Italy is a third economy in the Eurozone, so you will see a massive increase of debt buildup in the West, in the entire world, but especially in Europe. It will actually expose certain fragilities that have been there for a number of years already. So this will lead to a gigantic peacetime increase of debt, a long crisis legacy. If debt increases, it will break the recovery. So if everybody is so far in debt, this is it's very hard to see how an economy jumps up very fast with so much debt, and will take decades to resolve. After the Second World War, a country like the UK was able to reduce its public debts relatively fast over the course of 2 decades. They had 50% debt to GDP and reduced it relatively fast over 2 decades. It was below 100% 20 years later. And how did they do that? On the one hand, they allowed inflation to rise. And secondly, the central bank capped interest rates. So if you look at debt to GDP, you take nominal debt, you divide it by nominal GDP. If you don't allow your numerator to grow because you keep interest rates limited and fixed, but you allow your denominator to grow because there's inflation, of course, the fraction goes down dramatically. And this is something that people are looking at right now. And let's cap interest rates, but they're at zero already. But we should be able to create inflation, and that could help. And the thing is, we should try to avoid subsequent crises. A banking crisis is something not a lot of people answered, but let's not forget, banks are much more capitalized than they were before the last crisis. But this is the biggest economic shock of the past 100 years. For a bank is basically melded into the economy. So the economy goes into a recession or into a depression. Banks will feel this. Their buffers will be hit. If there's a lot of bankruptcies, a lot of credits that don't get paid back, paid back, banks will actually take a hit. And so the subsequent crisis, a number of people actually indicate this as well: nationalism, protectionism, unilateralism. Cooperation and global coordination has never been more needed than it is today. Yet it seems that countries are choosing for an each one for himself mentality right now, and this could be problematic in the period to come. Now let's look at Europe. Maybe first, before we tackle the subject of Europe, the last poll that I've included. What will this crisis do to the future of Europe? So there's 3 potential answers. The first one is Europe will emerge much weaker. The second one is not a lot will change, and the third one is Europe will emerge much stronger. Let's see what you think of this one. Opinion is divided, but there seems to be a consensus forming. Let's say about half of the people feel that Europe will emerge much weaker. There's about a quarter which says not a lot will change, and there's another quarter which says Europe will emerge much stronger. Let's say I think the not a lot will change, as far as I'm concerned, would be a difficult one. For me, it'll be either much weaker or much stronger, because this crisis is so big. Either you use this as some kind of momentum to build a much stronger union and start doing much more together, or it's something like everybody for himself, and then of course the whole union would have a difficult time. Let's go to Europe. So the roundup of the immediate consequences is that the weakest countries are hit the hardest. So Spain, Italy, France. When it comes to crisis management, when it comes to the lockdowns, Sweden isn't as badly affected as, for example, Italy or Spain have been, which means that the lockdowns in Sweden aren't that bad as they were in Spain or in Italy, which means the economic consequences aren't as bad. So you see a chain going from the management of the crisis directly to if you didn't treat the crisis, the pandemic crisis, in a serious fashion, the only thing you could resort to are extreme lockdowns, with of course extreme consequences for your economy. You see that, for example, borders are getting closed off, which was unimaginable even during the asylum crisis. There was a complete lack of European leadership. So it's countries themselves actually saving their own companies. It was France saving Air France. It was Italy nationalizing Alitalia. It's Germany offering billions to Lufthansa. So this is something we haven't seen in a very, very long period. And so the European Central Bank is left doing the heavy lifting. They can actually print money, and they don't have any voters they have to take into account. So in crisis periods, it's often the European Central Bank which does the heavy lifting. So right now, every country is on its own. We've seen the Merkel-Macron initiative yesterday, which was welcome. And the key question is, will the European Union survive this crisis? So you see government debts ballooning. Renationalizing of strategic assets. Germany is actually pouring money into almost every industry sector that they have, whereas other countries don't have the means and cannot do this. This will change the power balance forever after the crisis. Border closures, and of course a tendency to rescue your own companies and industries. And if you look at the fiscal efforts that have been done, so if we take into account that this crisis is a 10 to 15% hit to your GDP. So I expect the economy in Europe to contract this year by 10 to 15%. Let's see what governments have been doing in the meantime. For example, Belgium has been injecting 0.7% of GDP, which means that if your economy contracts by 10%, the remaining 9.3% of GDP is a hit that will be taken by citizens or companies immediately. Denmark is doing more. Look at Germany. Germany is injecting about 7% of GDP. They're allowing companies to defer payments of Social Security taxes to the tune of 14.6% of GDP. And they're guaranteeing or giving liquidity measures for almost 40% of GDP. And see, the richer you are as a country, the more you save before the crisis, the more you could do. Germany can do a lot. Denmark can do a lot. The Netherlands can do a lot. Italy cannot do that much because they have a high debt already. Spain cannot do that much because they had a high debt already. And Belgium could not do that much either because they have a high debt already. Which is interesting to see because before the crisis, the countries actually reducing their debts, running fiscal surpluses, were being regarded as stingy. They were only thinking of themselves. It is idiotic that they don't spend much more money, etc. Right now, because they've been saving so much money and because they have so low public debt, they can spend when the time is right and when the times are bad. And that's actually what a government debt should be used for. You try to reduce your debt during bad times, during good times, to give you more room for maneuver during the bad times. So what other countries have been doing, for example, Belgium or Italy or Spain, when times have been fairly okay over the past couple of years, they didn't reduce their debts because they felt it wasn't the time. And right now, when the bad times strike, they don't have enough means to actually support the economy. And this ultimately will be the key bone of contention between, let's say, the North and the South in the upcoming Eurozone crisis, because I do think that Italy will become front and center again when it comes to a new episode of the Eurozone crisis. And so early in the crisis, there was talk of European solidarity. We needed Euro bonds. So Europe is a bit of a peculiar setup because we have a monetary union for a number of countries. We share the same currency, but we don't share the same debt. Usually, you have full monetary sovereignty when you emit debt in the currency you can print yourself. Now, we all emit debt in euro, but no single country can print the euro by themselves. We share that currency with a number of countries. And this is, of course, problematic, because if one country starts running up huge debts, and they look at their central bank, it is not their central bank, it is the central bank of all the Eurozone members. And this has been the bone of contention during the Eurozone crisis and will be again. So the idea is that if we truly want to move towards a monetary union, which is much more crisis resistant and crisis proof, we would need to actually shift more fiscal powers to the central level as well. And then the big question is, will countries ever accept this? In the past, we've seen monetary unions which have linked their currencies together but had separate fiscal policies. Doesn't work. whether it's Bretton Woods, whether it's the Latin Union, whether it's other currency arrangements, doesn't work. But if you start by unifying politically and then introduce a single currency, that works. The US at times there was the New York dollar, the Ohio dollar, and then when they were a political union for some time, then they started paying with the same currency. Italy just the same, Germany just the same. It was when Germany was reunified, they still had multiple currencies, but when they were a political union for some time, they actually started paying with the same currency. And that's the same thing you have right now. And so the idea is, can you ever have one single debt instrument for Europe? And at the beginning of the crisis, there was a lot of talk about Euro bonds. We should have Corona bonds or Euro bonds. And so the pros would be that you would show solidarity in very harsh times. The strongest countries would lend their credibility and deep pockets to the weakest countries. Germany, Austria, the Netherlands, Finland could actually lend their credibility to the weaker ones, and it would shield countries against market attacks. If Italy could say, well, I'm backed by Germany, I'm backed by the Netherlands, it makes it much less likely that they get attacked by financial markets. The cons are, there is already a mechanism, which is the European Stability Mechanism. It already exists, but there's conditionality. You can borrow money from that emergency fund, but you have to do certain reforms. And that is something these countries didn't want to do. Then there's different ways of showing solidarity that don't entail mutualizing debt. I often compare it to the following situation. Let's say my neighbor has a fire in a part of his house. What is the best solution? What should I do then? Should I, A, ask him to call his insurer and then help out where I can? Or secondly, give him my credit cards for the rest of his life? That's basically, very, very bluntly, the two options that are being considered. And I think that the North, Germany, the Netherlands, Finland, Austria, should show that they can, that should show solidarity with the South without automatically resorting to mutualizing all debt, because I think that ultimately will lead to the end of Europe. And so it's often said that the South will remember how stingy the Netherlands were and how stingy the Germans were during this crisis, not being willing to give money or solidarity to the South of Europe. But I fear the reverse is also the case. I don't think that it's fair to portray the North as being stingy and not thinking about long-term consequences. They have been thinking about long-term consequences. They reduced their debt before the crisis. That's why they're tackling the crisis better than countries which don't have a fiscal room. And this should be a lesson if we talk about fiscal policy. In good times, you should build up buffers for bad times. And again, it was shown during the Eurozone crisis, and it was shown again during this crisis. There's a second thing going on in Europe. That's a power grab by the biggest nations. Countries like France, Germany, but especially Germany, will try to strengthen their companies against foreign takeovers, against foreign competition, against foreign trade. And there's a power grab by the biggest nations. Trade nationalism, renationalizing vital industries. I wouldn't want to be the CEO of Ryanair or EasyJet if I have to compete in the next couple of years with a state giant in France that has gotten billions in loans from the government. The government will try to do everything to keep out competition and to make sure its own companies actually get the best deals. When the airlines start up again, I foresee that, let's say, the state-sponsored entities, Lufthansa, KLM, Air France, Alitalia, will get the better treatment, and let's say the really free market ones will be in for tough times. And this is problematic, because this is actually not what Europe was invented for. Europe was actually invented when we do trade with each other. It's not allowed to sponsor your own companies. State aid is forbidden. You should allow free competition across borders. And the opposite is happening right now. And so I fear that the smaller countries and the EU itself will be the losers, and the big countries with the deep pockets, they will be the winners. Maybe a bit on pandemics, because when this crisis will be over, it all will depend on how this disease or this virus actually evolves. So the first diagnosis is we panicked much too late. And it's interesting to see that at the end of January, when we were all still asleep and going skiing in Austria, in Ischl, and in Italy, etc. Nassim Taleb, which you know of, the Black Swan, Skin in the Game, he actually wrote a paper on the systemic risk of a pandemic via novel pathogens, which would be coronavirus. And his analysis was that in the case of a novel pathogen, a new virus, which is more deadly than the flu, which spreads more easily than the flu, especially in an interconnected world that we have today, it pays off to panic early. It took a number of countries up to the beginning of March to actually see the severity of the crisis. So we panicked way too late, and especially with a process which is exponential when it comes to the spread of a disease is exponential. 2 people infect in total 4. Those 4 affect 8, 16, 32. It goes extremely fast. The earlier you panic, the better. So that is the first chance that we actually missed. Despite the warnings of China, despite the warnings of Italy, we panicked too late. And so, what is the potential the potential scenarios on the infection cycle? So the first scenario, those professors, I think it's from the University of Minnesota, did this research. What could we expect? The first scenario is peaks and valleys. So we will experience again a peak in infections like we had the previous peak. We will, as infections start rising, there will be a new lockdown, and lockdown starts impacting the spread, and the infections will go down again. Lockdown is eased, infections start spreading again, lockdown, over the top, lockdown will be eased. So that's working in the assumption that you will have for the next 1.5 to 2.5 years a scenario like this. So a constant stop-go motion of peaks and valleys. What does this mean for companies? It means that efficiency won't be the most important thing to look at in a company. Having as much profit as possible is not important. Having as much cash as possible will be important. Being as efficient as possible will not be important. Being able to survive will be important. So that determines how companies, how economies survive. The second would be the worst scenario. That is a peak in the fall. Would actually mean that we have seen this peak, but then the fall season, which is the season of people getting a cold, etc., that the peak would even be bigger. The lockdown would be much more severe. The impact on the economy would be much more severe. But afterwards, with the virus, etc., being under control, vaccines, etc., it will be under control. And then the best scenario would be the slow burn. It would be that we've seen the worst, and we'll see gentle upticks of the virus, but never again a full lockdown again. Now, I'm getting a question here, which I'm going to answer immediately, is that the evaluation of recovery scenarios are all fully based on a no vaccine situation. And so the idea is, when could we have a vaccine? When it's based on taking into account the a potential vaccine. Now, we've had the opportunity to speak to some senior people at the Coalition for Epidemic Preparedness Innovations. This is the organization that is put into place by the Gates Foundation and the World Health Organization. And so they're pretty pessimistic when it comes to a quick vaccine that could be administered to everybody. So even the World Health Organization says we'll have 4 to 5 years before it's really under control. So the idea is you need 5 billion doses right now. Let's say 10 billion to be on the safe side, to make sure you have a vaccine for the world as a whole. This largely exceeds the current production capacity of the big four, which is GSK, Sanofi, Pfizer, and Johnson & Johnson. For example, GSK, which is the biggest producer of vaccines in the world, can do 750 million vaccines per year from 2021 onwards in the best case. So make the calculus, and it's not before 2022 that you can have these vaccines ready for the entire world. There's a lack of coordination on EU level, tracking, tracing, the measures, distribution of a vaccine. A second wave will come, and there's nationalistic behavior versus the need for global coordination. For example, the CEO of Sanofi already said, that because the US has funded a big part of the research into the vaccine, they will get the vaccine first. Now, this, of course, would be very, very bad news. And then finally, and this is a growing problem as well, anti-vaccine movements. 1/3 of French people have already indicated they will refuse a vaccine. So even having a vaccine will not doesn't mean that we will be living in a COVID-free world pretty soon. So we have to be realistic on how fast this recovery to normal will be. And then the question is. Let's return to normal. So will we ever return to normal? A lot of people seem to assume that there will be a relatively quick return to normal. Once this is over, we return to normal. Well, there again, I would assume that this is going to be the new normal. Not the lockdowns constantly, but we will have to live with this virus sometime to come. And there's three factors I want to, three recent examples I want to point to indicate that for some cases we never ever return to normal. When the atomic bomb was first used, 2 times Hiroshima, then Nagasaki, in the course of a week, this changed the calculus of defense, globalization, Cold War, arms race, military spending, etc., for decades to come. The way we look at nuclear power, the way we look at the army, the way we look at nuclear weapons has been changed forever because of one event, 2 events taking place over the course of a week. 9/11 just the same. This was one single big terrorist attack. This was an outlier when you look at the international comparisons of violence, of terrorism, etc., but it's changed the calculus forever. If you see the security measures on airports, the way you're being checked on airports, the way you have given up privacy because of more security, the way traveling to certain countries has become much more problematic. It's 20 years ago that these attacks took place, but yet they still impact our lives today. And then finally, a very recent example, Harvey Weinstein, the whole Me Too movement has impacted forever the way people look at power relations at work, the way women miss certain job opportunities, the way certain men behave, the way certain managers behave, diversity on boards of directors, etc., etc. This changes the calculus forever. It's a paradigm shift, and this I guess we will see as well. And the faster you adapt to this new normal, I think the faster we will be able to thrive in it. And so, which future scenario will we have? I think it's 3 main switches, on or off. So that will determine the economic future for the next 2, 3, 4 years. So, quick vaccine, unchanged behavior, no second round effects. Best case would be we have a quick vaccine. People, companies don't change their behavior, keep on flying, keep on going to hotels, keep on going to restaurants, and there's no second round effects. No populism, no extremism, no Eurozone crisis. Best case. Worst case, vaccine doesn't come quickly. People change their behavior structurally. People stop going to work in a normal fashion. People work from home all the time. I mean, could be nice, but it has huge consequences for people having invested in these office buildings, etc., and that kind of stuff, leasing cars, etc. And then second round effects. If we have no vaccine, behavior changes dramatically, and there are second round effects, then it's a whole new world. I personally think vaccine, I would put the button in half. I think here just the same. Behavior will change to some extent, and there will be a number of second round effects, and we will get better through them if we coordinate between countries, and that'll be the big difficulty in the coming period. And so change will be inevitable. So Milton Friedman once said that only a crisis produces real change, and when the crisis occurs, the actions that are taken depend on the ideas that are lying around. And so which ideas that are lying around will determine what policy will do. And so suddenly the politically impossible becomes politically inevitable. This could be the basic income. This could be economic nationalism. This could be a tax on wealthy people. This could be massive state employment. This could be massive green investments. The ideas that are lying around will determine what course of action politicians or politics will follow in the next years. Now, maybe final conclusions for, let's say, the period going forward for companies as well as for governments. I would say there's going to be a new normal. Expect the unexpected. Technology, digital, AI will only accelerate. So if you don't have to bring people together but can have technology do stuff, that is going to be the future. You see an accelerated introduction of digital right now. We should imagine the future of work and adjust. I think if people have spent more than 6 months working from home, or even 3 months working from home all the time and not going to the office, these people will never, ever return to an office 5 days a week. They might go 1 day or 2 days, but they will never return 5 days a week, with, of course, consequences for the way the economy is organized, the way cities function, the way people organize their lives. That will have a huge consequence. As I said during the presentation as well, resilience will become much more important than efficiency. Squeezing the last euro out of your production chain or your production facility won't be that important. Resilience will be. Is my company able to survive a 2 to 3 month lockdown? Is my country able to survive the unexpected? That will be what is most important. And of course, resilience also means that we start taking into account other risks. As a policymaker, we've seen the risk of financial crisis 10 years ago, liquidity crisis. We now see the risk of pandemics. There's other crises as well. If this means that countries, governments, politicians start taking into account the unexpected much more, it could be cybersecurity, it could be armed conflict, it is climate change also. If we start taking into account these things more seriously because of this pandemic, I mean, that will be one of the good things that comes from this. And finally, prepare for creative destruction. We will see a number of industries disappear. There's a tendency to save all these industries and to keep them afloat. You could wonder if France would have pumped 10 billion euros in, let's say, high-speed railroads all over Europe rather than saving an airline, whether that would have made a difference to our economic future. So we have a tendency to save what is established, what is visible, and where a lot of people work. Whereas the new activity will come from new businesses. It's new kind of restaurant concepts. It's new ways of going on holidays. I mean, those are the new things that should get opportunities as well. And I think these are the main conclusions as far as my presentation is concerned. Then let's go to a number of questions that you've posed. I have one question here that says, what is your opinion on using the momentum of the crisis to create a more sustainable economic model? I think that's a very good question. This is actually what a number of people are actually pleading for right now, even on a smaller scale. If France is pumping money into its airline, Germany is doing the same. They're asking for sustainability criteria. So they don't want to invest in polluting planes. They want to have alternatives to that. That is a whole idea. Now, I think you're more alluding to a whole system reset in which a place with less inequality, maybe more government intervention. There's always a tendency to look for these kinds of massive solutions in these uncertain times. In times of big crisis, when the financial crisis struck, we heard the same stories. When the crisis of the 70s struck, we heard the same stories. I do think that, let's say, capitalism has its big advantages, but I do think a number of factors, let's say the hyper-globalization, the fact that we've outsourced a lot of our strategic assets to other countries, that is something we will start rethinking. Then there's a question, what's your opinion on the impact of COVID-19 on developing economies like India? So I think the problem obviously is that countries like India would depend a lot on exports on the rest of the world economy. And of course, with the world economy going into a very big recession, it'll be very hard to sustain that model. So I think that a lot of emerging markets will be hit disproportionately by this crisis. A couple of weeks ago, the Financial Times wrote that 90 countries have asked assistance of the International Monetary Fund. So that's 90 countries, which is about half of all the countries in the world. Now, any insurer knows that if more than half of your policyholders start asking for a payment, the insurer itself is bankrupt. So I think that emerging markets will face a tough time because of this this crisis. There's a question: what are strategic assets? Well, strategic assets are for example, right now, pharma are strategic assets. You could say airlines are strategic assets. Energy is strategic assets. Banking, insurance, those are strategic assets. So those are the ones that in difficult times you want to have close to. You don't want to sell out. I think that is that's an important one. There's a question on fiscal competition. With regard to fiscal measures, do you foresee countries to increase competition between themselves? It's a bit too early to tell. So the idea behind that would be that some countries don't increase taxes too much, and therefore become some kind of tax havens in Europe. What you saw before the crisis already was that the big countries had been fed up with let's say the behavior of the small open economies that try to attract investment with special fiscal measures. Let's think of Amazon in Ireland and Starbucks in the Netherlands, Luxembourg, Belgium, and it's always small open economies that have to use these fiscal measures to attract foreign investments. And why is that? It's because they don't have the market size. France is a big country with a lot of people speaking one language. Germany, just the same. United Kingdom, just the same. Spain, just the same. If you're tiny Netherlands or Luxembourg or Ireland, you have to offer something else to be attractive. So before the crisis, there was already a lot of scrutiny from the big countries for these special measures or these sweetheart deals that these small countries were closing. I think that after the crisis, they're going to be even stricter on that. So although the small countries would like very much to offer deals to keep on attracting investment, I think the big countries will try to avoid this in the next period. Then, do you see the environment being sacrificed? There's a question, do you see the environment being sacrificed in order to ensure an accelerated return to normal? So the idea would be then that we say we don't really care about climate anymore. People's incomes, our prosperity is much more important than climate. I think it could go both ways. It could go both ways. If people say, if this is what, let's say, Greta Thunberg wanted, no flying, no cars, economic depression, and this leads us to the desired fall in CO2, this is not the price I'm willing to pay. So that is a potential avenue. That's a potential possibility. Or we could say, and that's the other extreme, we could say, this has shown that we're not able to deal with the unexpected. If we have climate change which strikes, I mean drought, temperatures which increase, food production which comes into danger, this is a real strategic threat. If you look at all the reports by the World Economic Forum and other ones, for years they've been writing about pandemics being an issue, and for years they've said that climate change is an issue. As I said, if this pandemic leads us to take these long-term risks much more seriously, that will be a good thing. And then there's a middle way, which we say we don't need to go to an economic depression to be CO2 compliant. And let's take into account the fact that these long-term risks can become real, can materialize at a certain point in time. And let's realize that we need to do the investment anyway. We need the economy to get going again. I mean, I'd rather have, if we have billions to spend, well, spend it on something that is green. Spend it on something that is sustainable. Isolate your houses. Look at local energy networks. Look at the electric cars and charging facility. Look at the electricity grid in Europe, modernizing that. Look at your public transportation. Look at the way people are living and moving in cities. I mean, these kinds of things. If we would do an investment, do it with the long term in the back of your head. So I think that would be a very important one. Then there's a question on financial market itself, which says that I talked about the different curves on economic perspective, but what curve would the financial markets follow? So people assume that there would be a U curve or a W curve. I think that financial markets will face a very difficult time, let's say the end of June, beginning of July. And why at that point in time? Because up to now, financial markets have seen only two things. They've seen news about the economy being in a bad shape, and they've seen the reality of central banks pumping trillions into the economy, governments doing the same. Now, what I feel is that the reality of the economic destruction isn't very clear to financial markets yet. So we will start seeing that when the companies will start reporting on second quarter figures, and that'll be the beginning of July. Then it will be clear what the impact of the lockdowns and the pandemic and of consumer confidence are on actual companies' earnings. Stalin once said, "The death of one person is a tragedy. The death of a million is a statistic." What we've seen up to now is statistics. Unemployment rises to X%. X% of companies will go bankrupt. Economy contracts by 10%. Those are statistics. But the actual tragedies, the actual company closing doors, the actual main shopping street in which 1/3 of all windows will have a for sale sign, that is something that that will take some time. Maybe the final question, because it's almost at the end of the presentation. It's almost 12 o'clock. Will the current situation have an impact on the way we will provide education to our children? Will remote teaching become the new normal? I do think so. I do think that a lot of the habits we're developing right now are here to stay. I'm hearing a lot of people, we've seen a lot of polls in a number of companies asking whether people are more productive, less productive, or as productive before the crisis. Most people are as productive or more productive. The only ones having trouble are the ones that have small children, which is understandable because they cannot occupy themselves. So that actually weighs on your productivity. But as I said, if you've stayed home for a number of months, you will never ever want to return to an office again for 5 days a week, being stuck in traffic. Right now, people can work more productively. They work more efficiently. Meetings don't last as long as they did before the crisis. You have more spare time. You can do more sports, spend more time with your family. And so I think this will be the new normal. As far as teaching is concerned, just the same. Teachers and schools have had to deal with this crisis, but I think they will start developing new models to actually make this into a new model. I mean, who needs schools everywhere when you can have the best teachers actually teaching much more pupils at the same point in time, when you have better courses, better education? So I said there's going to be creative destruction. Some sectors, some old ways of doing business will disappear, but there's a lot of new ones which will thrive enormously in the next couple of years. And for me, the question is, how do I identify these and make sure that these are able to grow in the next couple of quarters and years? That's as far as I'm concerned. It's 2 minutes to 12, so I'd like to hand back the floor to Paula to maybe make some concluding remarks and practical details.
I would like to thank our guest speaker of today, Peter De Keyzer. Fascinating presentation, I thought, and I hope you who tuned in with us today thought so as well. Judging by the number of questions, I do think that was the case. Unfortunately, not everything. There was no time to handle every single question. So all I can say and recommend is come and follow Peter's course, 5th and 6th of October. Understanding Global Macroeconomics will be held at AIF. You can find Peter's slides under the handouts section. You can download the presentation there. And also, as mentioned before, no worries if you missed part of the presentation today. You will be receiving a link so you can watch the recording of the webinar at your own time later on. Our next webinar will take place a week from now, Tuesday, the 26th of May. It's also a free webinar. It will be on technology and specifically on blockchains and how technology is disrupting financial and other transactions, and whether blockchain can replace trust in those transactions in our new social distancing society. The webinar will be presented by Professor Raghu Rao of Cambridge University. You may have already received notification of it in your inbox, and if not, please visit our website, aif.nl, or see our LinkedIn page for more details. And I'd like to thank you all again for tuning in with us today, and I hope you join us again soon. Thank you. Bye-bye.